For decades, foreign direct investment followed a simple logic: cost and efficiency. But today, the rules have changed. Investors increasingly consider geopolitical alignment, strategic sectors, and industrial policy. The game is no longer just about cheap labor or low taxes. Foreign direct investment, or FDI, refers to long-term investments in foreign businesses or projects that give the investor significant control or influence. Unlike portfolio investments, FDI involves a lasting interest and a direct role in the management of the enterprise. For developing countries, FDI is particularly critical as it represents the largest source of external financing, accounting for about 50% of their total external funding. Beyond capital, FDI brings technology, skills, and access to global markets, making it a key driver of economic development and integration into global value chains. Companies invest abroad for three primary reasons. First, market access allows them to reach new customers and expand their operations into growing economies, such as those in ASEAN or under the African Continental Free Trade Area. Second, cost and efficiency advantages in emerging markets enable lower production expenses, which can improve competitiveness. Third, resource access ensures a stable supply of raw materials, such as minerals, oil, or agricultural products, which are critical for industries like manufacturing or energy. The attractiveness of a location for foreign direct investment depends on several key factors. High-quality infrastructure, such as roads, ports, and digital networks, reduces operational costs and improves connectivity, making it easier for businesses to operate efficiently. Proximity to major logistics hubs, like Berlin-Brandenburg Airport for Tesla's Gigafactory, can significantly lower transportation costs and enhance supply chain efficiency. Large markets, such as those in the European Union or China, offer access to a vast customer base, while the availability of a skilled workforce, particularly in sectors like digital technology or semiconductor production, ensures that companies can find the talent they need to thrive. The type of foreign direct investment a region attracts often depends on its geographical and economic characteristics. Resource-rich regions, such as parts of Africa and Latin America, tend to draw investment in extractive industries like mining or oil production, where access to natural resources is the primary driver. On the other hand, infrastructure-rich regions, such as Eastern China or the European Union, are more likely to attract investment in manufacturing, logistics, and services, where well-developed transportation, communication networks, and industrial facilities are critical. For example, Chinese investment in Africa has been shown to move in parallel with infrastructure development, indicating a strong connection between foreign capital and local economic progress. The motives behind foreign direct investment are evolving. While cost and efficiency advantages remain important, strategic considerations are increasingly shaping investment decisions. The rise of strategic sectors such as artificial intelligence, semiconductors, and critical minerals reflects this shift. Governments are also playing a more active role through industrial policies, using subsidies and incentives to attract investment in areas deemed critical for national or economic security. Additionally, geopolitical considerations such as alignment with allied countries are now influencing where and how companies invest, marking a clear departure from the purely economic calculations of the past. Today, foreign direct investment is increasingly concentrated in strategic sectors that are critical to future technologies and economic security. Investments in artificial intelligence infrastructure and data centers have surged, with project values in digital infrastructure growing by over 80% in 2025. Semiconductor production is another major focus, with international investment expanding at an annual rate of 54%. Critical minerals, essential for technologies like electric vehicles and renewable energy, are also seeing strong growth in investment. These sectors are not only economically valuable, but also strategically important, as they underpin the technologies that will drive future innovation and competitiveness. Governments around the world are increasingly using industrial policy tools to compete for foreign direct investment. Subsidies, tax incentives, and other forms of support are deployed to attract investment in sectors considered strategic for national or economic security. This approach reflects a shift from purely market-driven investment to a more targeted effort to build domestic capabilities in key industries. By offering financial and regulatory advantages, countries aim to position themselves as attractive destinations for high-value investment that can drive long-term economic growth and technological advancement. Geopolitical tensions are reshaping the geography of foreign direct investment. Supply chain disruptions and rising geopolitical rivalries have led to a fragmentation of global investment flows, with capital increasingly concentrated among countries that share political or economic alignments. This trend has been particularly evident since 2018, as investors prioritize stability and security in their decisions. Additionally, more countries are implementing foreign direct investment screening mechanisms to monitor and control investments in sensitive sectors, such as semiconductors or artificial intelligence. Trade policies, including tariffs on critical imports like steel and aluminum, are also pushing companies to reconsider their sourcing strategies, often leading to reshoring or nearshoring to reduce exposure to geopolitical risks. The restructuring of global supply chains is not taking the form of a broad relocation of production to new or lower-cost locations. Instead, companies are making selective adjustments to their investment networks, driven by a combination of risk diversification and local incentives. For example, multinationals are shifting some production and sourcing activities towards regions like Southeast Asia and Eastern Europe. This trend began during the pandemic and has accelerated, reflecting a more cautious and strategic approach to supply chain management. Rather than abandoning established hubs, companies are balancing their operations across multiple locations to enhance resilience and reduce vulnerability to disruptions. Foreign direct investment can bring significant benefits to host countries. It provides much-needed capital for infrastructure projects such as roads, ports, and energy systems, which are essential for economic development. FDI also creates jobs, particularly in special economic zones, and can drive local economic growth. Additionally, it facilitates technology transfer, as foreign companies often introduce new organizational practices, managerial expertise, and advanced technologies. Finally, FDI helps integrate host countries into global value chains, giving them access to international markets and enhancing their competitiveness. While foreign direct investment can bring many benefits, it also carries significant risks for host countries. One major concern is crowding out, where foreign firms displace or preempt domestic investment, limiting the growth of local businesses. Another issue is regional inequality, as FDI often concentrates in specific areas, such as coastal regions, leaving inland areas underdeveloped. Additionally, FDI can lead to environmental and social risks, including environmental degradation and poor working conditions, particularly in industries like mining or manufacturing, where regulations may be less stringent. Foreign direct investment is not evenly distributed across the globe. In 2025, the top 20 recipient countries captured over 80% of global FDI inflows, highlighting a significant concentration of investment in a relatively small number of economies. Several factors contribute to this uneven distribution. Large markets, such as those in China and India, offer access to vast consumer bases, making them more attractive to investors. Good infrastructure, including ports, digital networks, and transportation systems, also plays a critical role in drawing investment. Political stability and low risk further enhance a country's appeal, as investors seek predictable and secure environments. Finally, regional integration, such as through agreements like ASEAN or the African Continental Free Trade Area, can make countries more attractive by providing access to broader markets. In addition to the risks already mentioned, foreign direct investment can also lead to economic challenges such as profit repatriation and enclave economies. Profit repatriation occurs when the earnings generated by foreign-owned companies are sent back to their home countries rather than being reinvested locally, which can limit the economic benefits for the host country. Enclave economies can emerge when foreign investment is concentrated in specific sectors, such as extractive industries, without creating broader economic linkages. In these cases, the benefits of FDI often remain confined to isolated projects with little spillover into the local economy.